Here's a statistic that should bother you. The majority of people, even people with steady incomes, people who are reasonably financially aware, people who know they should be doing something with their money, have never made a single investment. Not one. Not a share, not an index fund, not a retirement account contribution beyond whatever their employer forces them into. Nothing. And it's not because they can't afford to. It's not because the tools don't exist. The barrier to starting has never been lower in human history. Anyone with a smartphone and 20 euros can invest today. So why exactly is it that they don't start today? Today, we're going to answer that honestly. Because the real reasons people never start investing are almost never the ones they admit to. And once you see them clearly, they lose their power. Let's get into it. Reason number one, I don't know enough yet. This is the most common one. And on the surface, it sounds responsible. I want to learn before I act. That's sensible, right? Except, how much is enough? Most people who say this have been learning for years. They've read articles, watched videos, listened to podcasts, and they're still not invested. The truth is, this isn't really about knowledge. It's about fear dressed up as preparation. Because if you waited until you fully understood something before doing it, you'd never learn to drive, never start a business, never do anything new. You don't need to understand every investment vehicle, every market cycle, every tax implication before you start. You need to understand one simple concept well enough to take one simple action. That's it. Reason number two, I'll start when I have more money. This one is particularly costly because of how compound interest works. Every month you wait is a month your money isn't growing. And the cruel mathematics of compounding means that the years you miss at the beginning are the most expensive years of all. The money you invest at 25 has 40 years to compound. The money you invest at 45 has 20. The difference in outcome is not double. It's extraordinary. There is no perfect time to start. Actually, let me correct that. There is a perfect time to start. And that perfect time is right now. Today. Not next month. Not when things feel more stable. Now. Because later always costs more. Reason number three, investing is too risky. This one is interesting because it's partially true and partially a misunderstanding. Yes, investing carries risk. But here's what most people miss. Not investing also carries risk. The risk of inflation slowly destroying the purchasing power of your savings. The risk of reaching retirement with nothing but a depleted savings account. The risk of spending 40 years working and having nothing to show for it financially. Risk is not something you can avoid. It's something you choose. The question isn't, how do I avoid risk? The question is, which risks am I willing to take? And which risks am I taking by doing nothing? Reason number four, the market is going to crash. There's always a reason the market might crash. Always. And people have been using this reason to avoid investing for decades through bull markets, bear markets, recessions, recoveries. Here's the thing about market crashes. They happen regularly. And then the market recovers. And then it reaches new highs. Every single time in history, over long enough time horizons, markets have gone up. But here's what most people miss entirely. And this is what separates successful investors from everyone else. Market crashes are not disasters for informed investors. They are opportunities. When everyone else is panic selling, the best investors in the world are getting ready to buy. They're picking up shares in great companies for cents on the dollar. They're building positions that will multiply in value when the recovery comes, and the recovery always comes. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That's not a cute quote. That's a strategy. Crashes are sales. And if you understand what you own, a sale is never something to fear. Reason number five, I don't want to lose money. Nobody does. But consider this. If you put 1,000 euros in a low-interest savings account today and inflation runs at 3% per year, in 10 years, that 1,000 euros has the purchasing power of roughly 740 euros. You didn't lose money on paper, but you lost real value. Quietly, invisibly, year after year. Loss aversion, the same brain glitch we talked about in an earlier video, makes the idea of a temporary market dip feel catastrophic, but it blinds people to the slow, certain erosion of doing nothing. Here's what investing actually is, stripped of all the complexity and fear. Investing is putting money to work in something that generates returns over time. That's it. And there are essentially three paths you can take, and the right one depends entirely on how much you're willing to learn. Path 1. Educate yourself and invest directly. This is, in my view, the most powerful option, and the most underestimated one. Most people assume investing in individual stocks or companies is reserved for experts with years of experience. It's not. Warren Buffett has said that if you're not ignorant and not lazy, you should invest in well-run companies, diversified across different sectors. Do the work. Understand what you own, and you will outperform any passive index fund over time. The key word is education. And here's the thing. People don't realize. The education required to invest intelligently doesn't take years. The core principles, how to identify a well-run company, how to value a stock, how to diversify properly, can genuinely be learned in a weekend. In fact, one of the best courses available for this, and in my opinion, the best value for money out there, is linked in the description below. Investing is not as complicated as the financial industry wants you to believe. It's a learnable skill, and once you have it, it's yours for life. Path 2. Work with a professional. If learning to invest yourself genuinely isn't something you want to do, a good professional investor or financial advisor is a legitimate and often excellent option. There are professionals out there who consistently generate 10, 12, even 15% returns annually, well above what most index funds deliver. The key is finding the right person. Look for a track record. Ask about their approach. Understand what you're paying and what you're getting. A good advisor is worth every cent. Path 3. Index funds. If you genuinely won't educate yourself and don't want professional help, then yes, a low-cost index fund is far better than doing nothing. An index fund tracks a broad market, like the S&P 500 or a global index, and gives you average market returns over time. Buffett's famous recommendation of index funds was specifically aimed at people who won't do the work themselves and don't have a trusted advisor. It's the baseline option, not the best option, but far better than leaving your money idle. Whichever path you choose, the important thing is to choose one, and to start. So how do you actually begin? 3 steps. Step 1. Decide your path. Are you going to invest yourself, work with a professional, or start with index funds while you learn? Make a decision today, not next week. Today. Step 2. Open an investment account. In most countries, this takes about 15 minutes online. Look for a reputable broker with low fees. In Europe, platforms like Trade Republic, DEGIRO, or Interactive Brokers are widely used. In the US, Vanguard, Fidelity, and Schwab are the established names. Interactive Brokers in particular is available in most countries and used by both beginners and professionals worldwide. Step 3. Make your first contribution automatically. Start small if you need to. 20 euros, 50 euros, 100 euros, whatever you can manage right now. Set it up as an automatic monthly transfer. The pay yourself first principle applied to investing. It moves before you have a chance to spend it elsewhere. Over time, increase the amount. As your knowledge grows, your approach can evolve. But the starting point is simply to start. Let's bring it together. Most people don't invest, not because they can't, but because fear disguised as logic keeps them waiting for a perfect moment that never comes. The knowledge will never feel complete enough. The timing will never feel right enough. The risk will never feel low enough. The antidote is the same regardless of which path you choose. Start small. Start simple. Start now. Educate yourself if you can. Find a trusted professional if you prefer. Or begin with an index fund and build from there. But begin. There is a perfect time to start investing, and that time is today. If this gave you a push, hit the like button. It helps more people find this content. Drop a comment and tell me, are you already investing? Or is this the video that finally gets you started? I read everyone. Subscribe and tap the bell, because next week, we're diving into something that affects every financial decision you make, often without you realizing it. The psychology of money and why your relationship with money matters more than how much of it you have. Thanks for watching. I'll see you in the next one.